What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Vivek Paul, Global Head of Portfolio Research at the BlackRock Investment Institute. This week, we unpack why we think investors could up their infrastructure exposure. Last week's corporate earnings from mega-cap tech companies showed massive investments in AI are ongoing. Beyond mega-cap tech, we see a clear beneficiary: infrastructure. Most investors could increase their exposure in our view. Corporate earnings in the fourth quarter show the capital spending behind the AI build-out is rolling on. This is a boon for infrastructure, which has typically been viewed as defensive. Beyond the AI build-out, other megaforces, such as the low-carbon transition, support long-term demand. But valuations do not yet reflect this. On an enterprise value to EBITDA basis, publicly listed infrastructure equities trade at a steep discount to their long-term averages. Private infrastructure trades closer to long-term averages, unlike private equity, and that helps make infrastructure our preferred growth private asset. Infrastructure is diverse. It spans transport, energy, telecommunications, and water and waste management. And investors can access it through both debt and equity vehicles in public and private markets. Yet most investors, including large institutions that typically dominate illiquid investments, are underallocated. Our analysis shows that a typical US corporate pension with risk comparable to a 70-30 equity bond split has infrastructure-like exposure of just 4 to 5%. We think adding infrastructure holdings is particularly helpful in an inflationary environment like today, where investors need income sources whose value won't erode over time. Infrastructure's cash flows are often supported by regulation and long-term contracts that adjust with inflation. This offers predictable income over the lifespan of investments. Two risks are commonly cited for infrastructure. First, an AI burst could choke demand for data center and energy infrastructure, though we think this is unlikely. Strong legal protections and infrastructure contracts help mitigate these risks. Second, higher real rates could push up the expected return threshold for infrastructure. We think this risk is the greater of the two and reflects structural forces like large government deficits and heavy bond issuance. Here's our market take. We like opportunities in infrastructure. Megaforces like AI are driving long-term demand, and valuations don't yet reflect that. We think most investors can increase their exposure. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com